Welcome you all in this class. Today we are going to calculate different kinds of cost of capital. But before starting today's class, I must suggest you people, please follow my previous class where I discuss the different types of cost of capital, how to calculate cost of capital of different instruments and their formula techniques, because unless and until knowing such formulas and techniques, it's going to be very much difficult to understand how to calculate different category of cost of capital. Let's take an example of how to calculate cost of equity share capital. It is written over here, a company shares is quoted in the market at rupees 20. The company pays a dividend of rupees 2 per share and investors expects a growth rate of 5% per annum. Calculate the cost of equity capital of the company. This is the question. How to solve this question? As you know, cost of equity, the formula is D by P plus G, where D stands for dividend per share. Dividend per share is rupees 2. P stands for market price per share or market value per share. Market value per share is mentioned over here, rupees 20. And G, that is growth rate, that is also available here, 5%. 5% we should consider as 0.05. Now let me count. It is 2 plus 2 divided by 20 plus 0.05. We are getting over here 0.10 plus 0.05, rather 0.15, which implies that 15%. That way we can get the cost of equity share capital. If you look at the question, dividend per share is available to us, market price per share is available to us, and growth rate as well. Then we should follow the formula of dividend growth model or dividend price model, whatever it may be. We apply that formula, plotting each and every components over here, apply such components into the formula, and finally we got the answer of 15% as our cost of equity capital, depending upon the question. Let's solve another question of cost of equity share capital. Let me go through the question. The equity share capital of a company present by 10,000 shares of rupees 10 each, fully paid. The current market price of shares is rupees 20. It is very much indicative. Current market price per share. The earnings available to the shareholders amounts to rupees 30,000. That is the link between 30,000 and 10,000. Remember, total earnings available for the company is rupees 30,000, whereas the number of shares is how much? 10,000. Once we divide that 30,000 by 10,000 number, we got rupees 3 per share. That is, we can consider as earnings per share. This is total earnings available for the company, which is 30,000. 30,000 in respect of 10,000 shares. Then earning per share is rupees 30,000 divided by 10,000 shares. You got rupees 3. At the end of the financial period, calculate cost of equity share. Let me first write down here the formula. Cost of equity equals to E by P plus G. G is considered as a growth rate. E stands for earnings per share. P stands for market value per share. I think it will remember the formula. Let me count at first E. E stands for earnings per share. How to get that earnings per share? What is the total earnings available to the company? That is rupees 30,000. Let me plot over here, rupees 30,000. That 30,000 is allocated for how many number of shares? That is 10,000 shares. Okay, then 30,000 divided by 10,000 shares, you got rupees 3. P stands for what? P stands for market price per share. It is mentioned over here, the market price per shares is how much? Rupees 20. Let me plot over here, rupees 20. Growth rate is not mentioned in the question. You can consider G as a nil balance. Let's count. E is 3, P is 20 and G is 0. Then you are getting 0.15. Then you can consider your cost of equity capital, rather what percentage? Your cost of equity capital is 15%. Now we are going to solve how to calculate cost of preferential capital. Let's take an example of cost of preferential capital. Cost of preferential. P Limited issued 10% preferential of 100 each. That means the value per preferential is rupees 100, on which flotation cost is 4%. There is a question. What does it mean by flotation cost? Let me explain that. At the time of issuing preference shares, equity shares, or rather debenture also, there are certain incidental costs associated in the issue process. You can remember that paperwork, you can remember that sometime brokerage, sometime commission, such kind of costs are associated with the issue process of financial instrument, such as equity share, preference share, debenture. Now, whatever cost we incur in the issue process in respect of brokerage, paperwork, commission charges, etc., such costs are basically termed as a whole as flotation costs. Remember that flotation cost percentage are directly chargeable on issue price, on transactions price. Now, preferential flotation cost is 4%. Preferential are redeemable after 10 years. Find the cost of preferential if tax rate applicable is 40%. What to do with the tax rate? Let me explain that one after one. First, of course, I am going to plot the formula of preferential capital. Let me draw here the formula. Hope all of you remember cost of preferential. The formula is D plus redeemable price minus issue price whole divided by N, again divided by redeemable price plus issue price by 2. This is the formula of cost of preferential capital. D stands for dividend per share in rupees. Okay. Now, how to calculate D? Look at that. It is 10% preferential and the value per preferential is given how much? 100. Of course, book value. Then D should be rupees 100 into 10%. You are getting over here rupees 10. Regarding redeemable price and issue price, if nothing is mentioned, it is thumb rule that the value which is provided, the book value, basically we consider as redeemable price and issue price as well. There are sometimes it is mentioned like a separate issue price or redeemable price. Like a share, a preference share can be issued at par, at premium, at discount. Similarly, it can be redeemed at the end of lifetime at par, at premium, at discount. Since no specific price is mentioned regarding the case of issue or redemption, that is why we consider here that the issue price and redeemable price are at par, and which is mentioned over here, that is how much? 100. But issue price we won't consider over here only 100. Why? If you look at the question, here it is mentioned flotation cost is what percentage? 4%. That means maybe when you issue such preference shares, there is a possibility of getting 100 rupees per preference shares. But remember, as I said that flotation cost is an incidental charges, that approx we consider that 4% of such amount which we can receive as a issue price, we have to pay to others. That amount should be deducted from our issue price. Flotation cost we have to deduct from our issue price. Then what is the percentage of flotation cost? 4%. Okay, you can write then out of 100 there is possibilities of getting 96% of such. Why 96%? Because 4% there is incidental charges. Then you get ultimately how much? Rupees 96. Or rather, you can consider the issue price such a manner also. It is rupees 100 minus rupees 4. Why it is 4? Because it is 4% or flotation cost. What is the issue price per share? That is 100. Then 100 into 4% rupees 4. Rather, you can write over here rupees 96 also. Any one of such you can consider in case of issue price. Now look at that redeemable price. Regarding redeemable price, nothing is mentioned regarding specific price is mentioned regarding redeemable price. Then you can consider the redeemable price is how much? 100. Next, N. N is the lifetime of the preference share. The lifetime of the preference share is how many years? 10. Just write over here 10. Over here. Then what is the objective of giving that income tax rate? Remember that if you exclusively follow the formula, there is no scope of apply income tax rate in case of calculation of cost of preferential capital. That is why in case of cost of preferential capital, we should ignore income tax. Now finally we are going to calculate here D, that is 10, right? Should plot over here rupees 10 plus redeemable price, that is 100, minus issue price, that is 96, divided by N. N is 10 years. Okay, 10 whole divided by redeemable price plus issue price. Redeemable price is 100. Issue price is known to us 96 divided by 2. Let me count one after one. 0.106. We can write 10.6%. Okay, 10.6% you can consider as your cost of preference share. Let's take an example of cost of debenture. Cost of debenture. Jet Limited issued 11% debenture of rupees 100 each, on which flotation cost paid at 3%. 3% flotation cost. As I said that it is incidental cost. At the time of issuing the debenture, we have to pay that cost. These are the incidental costs such as brokerage, commission, sometimes paperwork, different kinds of charges can be considered as a part of flotation cost. Which is 3% of the debenture are redeemable after 5 years. The lifetime of the debenture is 5 years at 10% premium. Find cost of debenture if tax rate applicable is 30%. Okay, let me solve that question. Before solving that question, let me plot the formula. I think you will remember the formula of cost of debenture. The formula of cost of debenture is I, that is basically interest, 1 minus T. T stands for basically tax rate, plus redeemable price minus issue price by N, whole divided by redeemable price plus issue price by 2. This is the formula of cost of debenture. Now try to articulate each and every item one after one. First I. I stands for interest per debenture. Follow here. What is the nominal value per debenture? 100. What is the interest rate? 11%. That means 100 into 11%. It is rupees 100 into 11%. You are getting over here straightforward, that is rupees 11. Next, tax rate, 1 minus T. 1 minus T, then T stands for tax rate. What is tax rate? It is mentioned over here, 30%. That implies that 0.30. Next, redeemable price. Redeemable price, I should plot over here redeemable price. What is the redeemable price? It is mentioned over the debenture are redeemable after 5 years at 10% premium. What is the nominal value for debenture? That is 100. If it is redeemed at 10% premium, then how much amount you have to pay as redemption? It should be rupees 100 plus rupees 10 percent of 100, then it should be rupees 110. 10 as a premium. It is mentioned over here. Next you follow issue price. In case of issue price, you have to consider the flotation cost also, which is 3%. Issue price over here. Now, since nothing mentioned regarding issue price, that is why the nominal value we can consider, the book value we can consider as a issue price. Now, what is the book value? That is 100 of course, but there is incidental charges of 3%. Then we should plot over here 100 into 97%. Since 3% out of the issue price you have to pay as a flotation cost, then it should be rupees 97. Rather you can consider such a manner also. It is 100. Say it is 100. Out of that 100, 3%, rupees 3 you have to pay as a flotation cost, then it should be rupees 97. How I got the 3? It is 100 into 3%. That way also you can count. That way also you can count the issue price. Now let me plot each and every components over here and try to calculate the cost of debenture. Then I is rupees 11. 1 minus tax rate is 0.30 or 30% plus redeemable price. Redeemable price is 110. Issue price, which is 97, whole divided by n. What is n? N is 5 years. Let me plot over here also. N, that is 5 years. Okay. Now divided by 5, bracket close. Whole divided by redeemable price plus issue price by 2. Redeemable price 110. Issue price 97. Whole divided by 2. Let me count one after one. We are getting 0.099. Okay, or rather you can consider it 9.9%. Then cost of debenture, how much you got? Cost of debenture you got 9.9%. Now we are going to calculate cost of term loan. Let's take an example. Cost of term loan. A company wants to undertake an expansion project costing rupees 5 lakhs. The cost required is 5 lakhs for that expansion project, which can be arranged at 9% from financial institutions. What does it mean? Like from financial institutions, if company lend the money took a loan that 5 lakhs rupees, the company needs to pay annually 9% return of such amount as an interest. Calculate cost of term loan if tax rate applicable is 50%. Tax rate is mentioned over here, 50%. Oh, if you will remember the formula of cost of term loan. The formula is I within bracket 1 minus T. I represent as rate of interest. Here if you follow, rate of interest is mentioned over here, which is 9%. Then I is 0.09 and T represent as tax rate percentage. Tax rate percentage is 50%. Then T it should be 0.50. Okay. Formula is KT, I mean cost of term loan. It's T denotes as term loan. I within bracket 1 minus T. Now we are going to plot 0.09, 1 minus 0.50. You are getting 0.045. Or you can write cost of term loan equals to 4.5%. Cost of term loan is 4.5%. In this class, we learn how to calculate separately cost of equity share capital, cost of preference share capital, cost of debenture and cost of term. Thank you.